But that's the best way to value, especially in the lithium sector, is how do you realize value? You need sales, you need profits, you need cash flow, you need revenues. And I think that's the way that, perhaps in a little bit more of a cognizant world or a cautious world, where with a bit of uncertainty coming up, those guys that are in production now, should get the benefits of upside valuations.
Welcome to the ASX Investor channel. Lithium stocks have been some of the hottest on the market over the past couple of years. And of course, investors know that companies that move into production of lithium have a significant opportunity ahead of them. So today we're going to dive into the story of what lithium production really means, talking to the Managing Director of Argosy Minerals, Jerko Zuvela. ASX AGY are right in the midst of transitioning from developer to producer. It's a very exciting time. We're going to talk about what lithium production really means, the process to get there, and of course, what some of the difficulties and challenges have been. If you're a fan of the lithium space, if you're interested in the EV transition, this is going to be a video you enjoy. Jerko, it's great to have you on the channel once again. Welcome back, mate.
Thank you very much. Really appreciate it. Lovely to be with you again.
It's great to have you here. There's a lot to discuss. I think first and foremost, let's talk about the lithium space. We've had some interviews previously. We've talked about everything going on, but what have you seen over this past period and how are those trends really evolving?
Yeah, listen, it's been a difficult, I guess, last few months for the lithium sector in general. Probably not many of us, 3 or 6 months ago, probably saw what was coming. Looking back, probably we should have been a little bit smarter in hindsight, but that's a wonderful word, smarter in hindsight. But, we all knew that those subsidies were coming off in China for EVs, that the internal combustion engine vehicle manufacturers were really going to push their market hard. Obviously, that they've got a time frame where they need to do that by, given that they're going to cease allowing that in China with internal combustion engine vehicles. Stockpiles were they were destocking. Some of these end users were destocking their lithium stockpiles. So looking back in hindsight, perhaps we should have seen that the Chinese lithium price was going to come back, and I think we've seen some commentary from the bigger guys in the sector about that as well. So probably looking back, we probably maybe should have thought it wasn't going to keep growing as it was sort of the back half of last year, because I guess we're all drinking the Kool-Aid last year, where we all thought, this is fantastic and everyone's going great guns, and it really does, sort of support what you're doing. But, there is the other side of the business, and that's when the lithium price has come back. We've seen it, obviously, the China spot price, the domestic China spot price has really come off, and that's really, sort of made it a little bit more challenging for companies like us and our peers, bigger and smaller, and a little bit more challenging with that lithium price. But the glass half full side of things is, the price is still well and truly above where it was 2.5, 3 years ago, or 3 years ago. It's probably 3.5 times that amount, the domestic China spot price, and probably 4 or 5 times the international market price. So there's still plenty of good things in the market, and there's still plenty of incentive for companies to get out there and get into production. And I guess that's exactly what we're trying to do, and we're moving down that path, and I guess there's a few others going down that path as well.
For sure. Of course, you talked about the parabolic run that we saw in 2022 in terms of those prices, but as you mentioned, well and truly above those 18, 19, 2020 levels. How's that thinking going internally at the moment in terms of where the prices are, and what are you seeing in terms of the demand as well as some of those discussions that you're having?
Yeah, listen, it is really a two-story sort of picture. As we've seen, obviously, the China market has really come off. That demand has waned, and that's why the prices have come back. And the other part of that story, when I said that, we maybe should have been all a little bit smarter, 3 or 4 months ago. That European and North American story, where these OEMs, these auto manufacturers, are coming into the market. We all knew that these guys weren't going to be needing demand this year, or probably perhaps even next year. It was always a 2026, 2027 story where their supply chains were going to need to get ramped up, and their EV story was really going to push out. And obviously, we're seeing the EU and the Critical Minerals Act or the Inflation Reduction Act in the US as well. This is all about setting these guys up for the next 3 or 4 years to then start, commercial mass production of these EVs. So, I guess that demand, we've seen whether it's GM with Lithium Americas with their Thacker Pass project, obviously Ford with Liontown. These OEMs, North Americans, Europeans, are still very aggressively looking to procure and secure their raw material supply. So it's not just lithium, obviously, as well. They are looking to secure the batteries that they need to feed into these vehicles. So even though that demand's not translating into hard demand for product today, but it is about securing that strategic supply of that product in years to come. And that's really where I think the market is at the moment. Everyone's sort of lining themselves up or getting themselves set to ensure that these bigger guys can do what they need to do, and they're coming down that supply chain and coming to companies like us who are near-term producers and future producers at larger scale. That's really what we're seeing in the market today, and that's not just the North Americans and the Europeans, but it's the Asians as well, because everyone is concerned about where they're going to get their supply from, and that's where the story's being driven from today. And I think that's where we see a lot of potential projects get developed from the capital that might be coming from these groups over the coming months or 6, 12 months, whatever it is. But I think we're going to see a few more of these sort of GM deals, these Ford deals into the market to allow companies like us to get funded to get into production at larger scale and provide that, from our perspective, a lithium carbonate to those guys to feed into their supply chains to get the batteries to build the EVs. And then that's where I think the market is over the next 6 to 12 months. We're going to see a lot more of that activity, which I think gives the market a lot more confidence that there is a long-term sustainable pathway in this sector. And in terms of pricing, where does that settle? Again, I think we're probably seeing a little bit of stabilization both in China and ex-China. But where does that price stabilize over the next 12 to 24 months? I think we're probably a little bit all gun shy given what's happened. But we all do know that those prices that we did see late last year probably were due to outside factors that probably aren't going to be as prevalent over the next couple of years. But saying that, that still may happen when these Europeans, these North Americans, these ex-China auto manufacturers and OEMs really need to put their foot down, because they've got huge production profiles to produce EVs. We still think it's going to be a struggle to provide the lithium chemicals to provide into those cathodes, to provide into those batteries to meet that demand. So we still think there's a crunch going to come. It's a question of when and what does the price do before then. Hopefully, it stabilizes between that sort of 25 to 50 mark. I think, what we saw recently, Benchmark Minerals is quoting the CIF North Asia or CIF Asia contract price at about $52,500. So, that's still pretty positive for most lithium producers, and albeit not as great as late last year, but it's still very positive and, generates a lot of profit for producers.
Yeah, it's fascinating, some of the activity you've described, whether it's the offtake agreements that have been ramping up. Of course, we've started to see some of those upstream investments as well into some of the projects. To paint the picture, it'd be great if you could take us through the Argosy story, how you found the journey to now. Of course, we'll go into a bit more granular detail, but just for viewers, how that process has been getting towards where you're up to now, right on the verge of production.
Yeah, and that's the hard part, is doing all the hard work. The easy part is at the end when it all looks fancy and hopefully you're making some good money. And obviously the sector is very much aligned and set up for companies like us to be able to do that. But it is a grind. We started at this project in effectively 2017. We built a pilot plant to test our technology, to prove up our technology. Obviously that went reasonably well through 17, 18. 19, 20, as you said, were very much tougher years for the sector. So we got slowed down there a bit. The market picked up in 21. We were able to get the funding to go and build this 2,000 tonne per annum plant. And again, not many others have sort of followed this pathway of step-by-step or staged production stage development. We think it's critical because, developing these chemical or lithium chemical processing plants to produce lithium chemicals is not easy. There's only 4 operations in South America. Obviously, there's a lot of these process plants, hydroxide and carbonate plants in China. There's a couple elsewhere around the world, but that's about it. So the technology, the expertise, the experience is not as prevalent and is not widespread to do this successfully. And I think we've seen it here in WA. You've got Tianqi who are building their facility in Kwinana. Wesfarmers are building theirs in Kwinana. They've just recently announced a blowout of $760 million US, and I think about a 12-month delay to build their 24,000 tonne per annum hydroxide facility. And that's what we're seeing. Tianqi, Albemarle's looking to do it. Others are talking about it. These things aren't easy to build. Requires a lot of expertise and knowledge. The experience is not there. These things haven't been done before. and we're seeing it is a challenge to bring them online. Tianqi's been at it for a good 4 or 5 years. These things aren't easy to build. So we think there's a lot of challenges that will really, we think, be the main deterrent or the main issue with providing that supply into the market over the next 3, 4, 5 years to meet that demand requirements, which hopefully is good for a bit of price rising. But I think it's, we've learnt this staged approach has really helped us lock in that technology, lock in the expertise and experience on building these things, because you can't buy it off the shelf. You can't get engineering groups because they've never done it before either. So it is very much a challenge, and we think this stage approach hopefully de-risks it for us. Always challenges. South America again, Argentina again, always meeting challenges. We've seen what they've done in Chile in recent times. We think that's an anomaly. Probably won't go anywhere else. But again, Brazil's got spodumene, Argentina's got a lot of lithium, a lot of private companies, which hopefully the government realises you can't do what they've done in Chile. But the Chilean guys are probably having a bit of a rethink. Again, SQM, Albemarle, the two biggest there. What do they do about their capital investment? With knowing what's just been announced, so they probably sort of be a little bit more cautious as well. So there's a lot of factors that are impacting new supply coming onto the market over coming years. Hopefully that's good for price, but also not. It's not great for the EV rollout. We're going to need as many people getting into production as we can. And like I said, from our perspective, we've learnt a lot. It de-risks our project moving forward. Obviously, we've got a little bit more to go with the 2,000 tonne per annum completion. We're in commissioning and ramp-up phase now. We're very confident that the chemical process technology is verified and validated, and that's going to move forward as we've outlined. We're going through a few mechanical commissioning issues that we need to processes that we need to complete. And that we're learning a lot, and I think that puts us in good stead when we do come out with the strategic arrangements for that next stage, get the approvals from the government that is getting closer, albeit it's been getting closer for a long time as well. But we think that really puts us in good stead with the workforce, with the expertise, the experience, the knowledge, and also attracting that right strategic partner to understand how difficult it is to do these things and get that all aligned so that we can be successful in coming years to not only complete the 2,000 tonne operation, but start building and complete the 10,000 tonne expansion over the next few years as well.
For sure. And we always hear a lot about the supply shortfall and a lot of the rhetoric and commentary around the fact that it's not easy to get lithium projects online from development to production. You've highlighted a few of them there, but it'd be great just to have a bit more elaboration on what are some of those difficulties. You guys are smack bang in the middle of this process now. What are some of those lessons learned and maybe some unforeseen factors that investors might not even consider as well moving into that production phase?
That's a loaded question there. A lot of things, obviously, that when you go from way to go, and I guess I mentioned about capital. Now, when you're Wesfarmers and you have a blowout of $760 million US, that's pretty easy to resolve because they've got plenty of money. But if that happens to a company like us or a new developer looking to go into production, you announce a $760 million blowout to your budget. Well, companies like that don't survive, unfortunately. So, we're very conscious to make sure we get our capital expenditure budgeting correct. That's key. We've seen in the past, whether it's Nemaska in North America, some of our peers in South America, and like I said, even the guys here in Western Australia, if you're a junior company looking to move up the ranks, you don't want to be having cost blowouts like that. The other big challenge is people having that expertise, as I said. Western Australia, we've never built a chemical processing facility to produce lithium hydroxide or lithium carbonate ever here before. In South America, like I said, there's only 4 operations. So, these sort of things are huge challenges, technical and technological. Haven't got the people, all the way down to supply chains. We've built our 2,000 tonne operation through COVID times. Obviously, the Russia-Ukraine situation, that's all impacted supply chains. Things like freight rates. They went from $50 a tonne pre-COVID to $500 per tonne during the height of COVID. It's come back obviously now, but these sort of things can impact costs. Cost is your biggest issue. Technology is your biggest issue. People is your biggest issue. So those things are the obvious ones. But like I said, the things that impact that, costs related to freight, supply chains, getting spares, getting pieces of equipment, getting the right commissioning groups to come and install certain pieces of equipment. That's challenging. Obviously, in South America, like I said, obviously on the Chile side, you've got what they've brought in there. That's you don't never want that. On the Argentina side, obviously we've got some regulatory issues that the government sort of enact or has got in Argentina, which make it a bit difficult. Capital controls, import restrictions. Again, these things you need to have experience dealing with. I think Rio Tinto came out for their Rincon project only a couple of weeks ago, saying that they're reviewing where they're at because of some of these issues. So you've got specific issues to Quebec again. Up in Canada, everyone knows to license and permit a project up in that part of the world takes a very long time. In Nevada, in the US, we've got a project in Nevada with our Tonopah project. Again, water rights is the biggest issue there. You can drill out and have a resource, but if you've got no water rights, and they're private water rights, if you can't secure water rights, then how are you going to process your materials? So there's a lot of challenges. I know I'm a shareholder in companies as well, and you think all this stuff should be just knowledgeable and resolvable, but some of these things aren't resolvable as easily as we'd all love them to be, and do it in a time frame that everyone expects you to do it in. So there's a lot of challenges. What other things are there? Even finding the right partners. Funding is a challenge in this industry. Like I said, we mentioned GM and Ford. I think the OEMs are coming into the game, but where else are companies going to get funding from to build these projects? Some of these projects are multi-billion-dollar capex. Now, how do you find that when you're a junior company? The big guys have got issues with technological expertise, whether it's processing, whether it's whatever, all the way down to even community relations issues. We see that in Australia, we see that in North America, Africa, South America, a lot of issues, and that's why these projects are generally not built to the time frame that we all expect on day one, and they all get delayed, as you said, because there's a lot of challenges and environmental impact issues, social issues, ESG, carbon emissions. You want to be building projects nowadays, especially out of the European push to decarbonize. You've got to try to build projects without emitting carbon. So how do you do that? You've got to become electrified. You need solar power. You need renewable energy. How do you do that? Your equipment needs to be all electric. Again, it's all out there, and that's what we're working on now, and that's what we've been able to take a lot of comfort from, that we've gone through that process and try to understand some of these challenges, but there's a lot of them out there for sure.
Sure, there's a lot of obstacles to navigate through. I guess that's the difficulty side, but there is also the positive and the upside as well when you move towards production. I'd love to get some insights as well, whether it's talking to potential funds or institutional investors, the perception that you're having as you move towards production, but also, of course, the valuation metrics start to change as well as you start churning out that cash flow. When you start generating that cash, how are you seeing that perception changing as you move towards that stage personally?
Yeah, again, 3 months ago, a lot of those funds and fund managers, institutions, and retail investors, like I said, we're all very positive thinking. We all knew that those lithium prices were probably a little bit unrealistic, but we all got very excited and, doing valuations, off the back of where the pricing or lithium price was going was very exciting. Reality is obviously setting now. So again, I think we've all sort of realised that, we do need to have a little bit more controls around what we think, what sort of valuations we put on based on prices and costs and so forth. But like you said, obviously, we've produced just during our commissioning sort of cycles and production trials, 13.5 tonnes to date. I think we announced last week or earlier this week. That's exciting to have product that's worth $40,000, $50,000, $60,000 a tonne that we've produced with over the last couple of years that we've spent our investor or shareholder funds on, is very exciting, because as you said, as that starts progressing, more and more money rolls through the door, and I think that's the best way to, over the longer term, or maybe when I say longer term, I probably mean short term, 3 to 6, 12 months, rather than very short term that perhaps some investors look at. But that's the best way to value, especially in the lithium sector, is how do you realize value? You need sales, you need profits, you need cash flow, you need revenues. And I think that's the way that, perhaps in a little bit more of a cognizant world or a cautious world, where with a bit of uncertainty coming up, those guys that are in production now, should get the benefits of upside valuations. The guys moving to that, hopefully we'll see, some companies like us will start seeing the benefit of that as we progress a bit more. But to me, the real value in this business is production, selling product at these prices, whatever that is, $40,000, $50,000 a ton. That's where you can justify the fundamental values. Anything before that, unfortunately, is a little bit of blue sky and reliant upon good management, good projects, and being able to deliver. And as we've seen, that becomes a little bit more challenging when times get a bit tougher. So, listen, obviously, there's a lot to think about there as well in terms of how do you value these things. But the plus side is those in production are still seeing great sales prices. I think we saw Allchem's quarterly say that they averaged $53,000 a ton last quarter. So that's fantastic. They're spitting out money. Pilbara has been a big beneficiary of spitting out a lot of free cash flow, and I think that's what everyone's aiming for, and that's what we think we should be valued on as we get there. But also once we get there, that should be a different position, because you've shown that you've done it, you can do it, and hopefully it de-risks it for further advancement as we're trying to develop.
An exciting milestone that you're embarking on. Of course, it's been a long journey to get here. Did you have any final reflections that you wanted to share with investors and those next steps as well on the Argosy story as you continue to move forward?
Yeah, listen, we're very excited of what's going on. Like I said, not many people get the opportunity to get in production from where we've come from. Very exciting. We're over the next probably 2 to 3 months, we think we're going to be kicking a lot of milestones. We've talked about it in our announcements, getting into steady state operations, continuous operations from the 2,000 ton operation, the strategic arrangements around the 2,000 and 10,000 ton offtake arrangements, the funding for the 10,000 ton expansion. That's all coming. We think the regulatory approval is sort of aligns with that sort of timing as well. And then, probably what we haven't talked about is, our resource expansion drilling works that we're doing. That's probably towards the end of the year, but we're having good success with the drill bit, and that's exciting for us to show that we can go from 2 to 12 as the next step. But we're looking at increasing that production profile and production target off the back of the success we're having with the drill bit, and what we're looking to do over the coming months to finish off that drilling campaign and really show that we've got a larger production profile, and hopefully the benefits that might come with having larger production, and hopefully more revenues through the door at some point in the future.
There's plenty of hard work behind you, but plenty of exciting things to look forward to as well. That's the Argosy Minerals story. It's ASX AGY. If you've enjoyed it, make sure you subscribe, hit the like button. Jerko Zuvela, a big thank you for joining us on the channel. Look forward to catching up again soon as well, mate.
Really appreciate it. Thank you very much. Have a great day.